2 minutes after 1, so we'll go ahead and get started. Thanks everybody for joining us today. We're super excited about this because Karin and I have talked about this idea for, a couple of months now. I don't know if you guys know, but my background is economics, and my master's degree is in econ with an emphasis in finance and real estate. And then Karin is an absolute rock star lender that's been in lending. She probably doesn't want to tell you how long, but a while. Right. I think she started at B of A, if I'm not mistaken, won a bunch of awards. She's currently the senior vice president of the Pacific Northwest for U Mortgage. Hopefully I have that right. She's also super high integrity and is a giver, right? So she is part of a nonprofit that does down payment assistance. And I'm sure she would love to share some of that with you guys, after the meeting today. But today, what we're trying to do for all of you, and then hopefully you can do for your clients, is taking the fear out of the market, talk about rate buy downs, talk about the difference between 2008, right? And what everybody's saying is, hey, this is like 2008 all over again, which Karin and I were just talking about 15 minutes ago is definitely not the case, and hopefully make everybody smarter after this and be able to close more deals. So with that, I'm going to let Karin say hello and then we'll get rolling.
Hi, guys. Well, thanks for being here. Thanks for the great introduction. Please forgive me. I have had this terrible plague, this flu, for over a week now. So I am Theraflued and Mucinex up for our meeting today. So if I go into a coughing spell, I apologize in advance. But thanks for having me. I've been really fortunate to, meet Russ and his team and, make a great connection over the last several months. And I love the fact that he is, so engaged when it comes to, really the economics. He's not, your average everyday realtor. He really is connected to, the pulse of the market and, finances and what's going on and what we're dealing with today and what's coming for the future. So he's an excellent resource. And I've really appreciated, building that relationship with him over the last several months. So a little bit of background on me. I have been in the mortgage industry for 22 years. I can't believe it. I got in right after I graduated from college. I have a degree in finance and marketing, which is kind of a strange combination. I like to tell people I'm a really interesting mix of like math nerd versus with social butterfly. So you marry those two things and that's me. So being in the mortgage industry is perfect. I really get to exercise those two parts of my brain and my personality. And I really, really love it. And I've seen a lot over the last 22 years that hopefully will be helpful to maybe give you guys some perspective today and hopefully take some of the fear out of this market and, really talk about what we're seeing coming up for the future and what we can hopefully, expect from that. I started as a wholesale account executive for Countrywide on the A-paper side, which was one of the biggest wholesale lenders of its time. So my job was to actually work with loan officers around my region to help them structure deals. So we were doing a ton of volume back then. And anytime I was engaged in a scenario, it was because it was a really difficult puzzle to figure out, or there was an issue, or there was some funky deal or some little teeny tiny guideline that, was exercised that I needed to come in and figure out a solution to fix that loan, get it back on track and get it back, into a positive track for closing for our loan officers and realtor partners. So that gave me a really unique perspective on originating and gave me kind of, this ability. Loan program guidelines really haven't changed that much, over the last 22 years. So knowing those nuances of every loan program and kind of how to use guidelines and use rules and regulations to essentially win battles when it comes to getting things done has really helped me as an originator. I've worked for a bank. I've worked for a retail establishment. I managed a branch of Academy Mortgage for 8 years. And now as a broker, I've kind of come full circle and have really been thriving over the last, 4 years since going from retail to wholesale because of the opportunity that we have as mortgage brokers for our clients, which you guys are our clients. So having opportunity and knowing that going into this market, there might be some, lenders and banks that might close. We've already seen that. Russ and I talked this morning about the implodometer that I'm sure some of you that have been around for a long time remember in 2008 when, the mortgage meltdown occurred. There were literally banks that were going out of business, lenders that were going out of business daily. And we were watching that happen in real time. So I don't think that's going to happen today, but there have been some, large organizations that have made some changes or stopped doing mortgage origination activity. And it's nice to be working and partnering with an organization that has many different lending options, because frankly, if half of the lenders out there close their doors, I still have access to, the other half of the lenders. So business as usual for us, which gives me a really, good sense of, essentially solidarity in the mortgage space. So on that note, let me share my screen here.
Awesome. We'll set up a little foundation. I know, let's talk about what you and I talked about first, and then take the fear out of the market from a lending perspective. Karin and I were just talking about 2008, right, versus 2022. And the difference is, in my humble opinion, in 2008, the housing bubble was created because we had a shortage of housing, right? And then we had these organic loan products. I don't know if you guys remember this. Variable interest rates, 80-20 loans, 100% financing, negative amortization, no doc loans where you could just state your income. It was all super crazy. And it was actually a housing bubble. We are still, since the Great Depression, in a shortage of housing. I think the last report that came out was almost 4 million houses that we're short on. And the difference this time in 2022 is we're actually trying to curb inflation by raising interest rate, right? There's a Federal Reserve Board of Governors. So the question that everybody asks, oh my gosh, are we going to have a market crash? My answer is no. And here's why. And Karin, you can disagree with me if you do. Number one, we still have a shortage of supply. Everybody knows that COVID majorly impacted the amount of materials that were available to build houses and made it much, much more expensive. And the housing starts, while they're up, we're still, finished housings are way, way lower than we expected. And we still have a shortage of supply. The inflation, right, caused by a whole bunch of stuff, right? We don't want to get into politics, but there's no doubt that year over year inflation is absolutely insane. And again, that's why the interest rates are going up. And so I think the only reason that we have a pullback in the market from an economic perspective is because housing prices are inversely related to interest rates, right? As interest rates go up, houses become relatively less affordable. However, the two major impacts on housing prices are supply and demand and inflation, right? We still have a restricted supply and over demand, so that drives prices up. And as inflation continues to increase, you can Google it if you want, because everybody believes Google. As an inflationary period happens, housing prices go up. It's actually a very good hedge against inflation. So I don't think we're going to have a housing crash. And so you can, hopefully explain from an economic perspective why that crash will not happen relative to 2008, where it was a true bubble that was created by all of these organic loan products that we had never seen before. And with that, I will pass it back to you so you can do the presentation on how we take the fear out of the market, how we purchase, right, given this little bump in the road.
Sure. Well, and I think it's important to note that in 2008, when we did experience this mortgage meltdown, the way we were qualifying buyers to purchase homes is completely different than the requirements that we have to adhere to today. And literally these rules and regulations were created out of just everything that was created in 2008. So literally, people make jokes that you could fog a mirror and get a mortgage in 2008, and that's accurate. We had loans that you could literally leave time on the job and time in the field blank on your application. Go get yourself a business license. Say that you were self-employed and you made $15,000 a month. You're just getting a business license 2 minutes ago, and if you had the credit score to qualify for a loan like that, you were approved. So as crazy as that sounds today, it was completely commonplace back then. And those were actually conventional A paper loans. So some of the darker, dirtier loans were a lot worse than that. I mean, there were all kinds of different loan programs that were designed to extend easy credit and not designed to asset and make a good financial decision going forward. So out of that crisis came ability to repay laws and different regulations and rules that, essentially have been created so that we do not have that scenario today. So although affordability and although our inflation probably still have supply issues, but what we also have are people that have mortgages today that qualify for them. So the credit quality in the market today is excellent, meaning if as this changes, I don't think there's going to be an onslaught of foreclosures due to the fact that people couldn't afford to repay those mortgages from the get-go.
Yeah, I think two things, right? I know at least in Northern California, over 60% of the homeowners have more than 50% equity in their home, right? So what happened before is because everybody had these negative AMs and 100% financing, as the market started to cool, they were all upside down. That's not the case today, is what you're saying, correct?
Absolutely. Absolutely. So, I think that's a big, huge differentiator. And definitely in terms of quality for, having this massive, recession bubble that everybody is fearing. It's not like I don't see that there's going to be this, big slew of foreclosures or people that essentially can't pay their mortgages because the credit quality is good. So that's positive. What has happened in the last, 6 to 12 months is the major shift in interest rates from, the high 3s, low 4s to, the mid 6s to low 7s. That happened so quickly that I think it was basically just it was the speed in which the market changed that has really, taken everything and kind of put it into hyperspace. And that's problematic in a bunch of different ways. But what we're going to talk about today is how that can actually work for us, because we now have buyers that are in the market that, assuming they still qualify, are serious. And I think we're finally in this period where it started to slow down and maybe be a more realistic market for people that were exhausted because they saw, 25 different homes over the last year. And you guys have been out showing them all these properties and they're getting beat out from person to person to person because they can't get into contract because there's so much competition. Oh, I think I was frozen for a second there.
No, I think you're good.
So I think that the biggest, what are you guys experiencing out there in terms of the fear? Let's kind of address that right now. Is there anybody that's like, what are the common things that you're experiencing that are making you worried or making your clients worried, or what are you hearing? What's the buzz in the market?
Well, I will say that more and more sellers are having some time on the market. So instead of a week or 2 weeks, it's 2 months, 3 months. And so it's educating them through the process of, we're going into a very normal paced market. You're not going to get all of those multiple offers, but, and there might be some give and take in terms of negotiation. So I think more and more from the seller's perspective, what I'm seeing is that they're worried that, an offer won't come.
That's a great
point. Also priced out.
What was that, Scott?
Oop.
Sorry about that. Was that just, I was just sitting there saying that buyers are priced out of the market in comparison to what they could be approved for and what their monthly payment would actually be, 4 or 5 months ago in comparison to now. We've had, a couple of nice drops here recently, but still it's quite a bit more per month.
Yeah, I would say, Karin, that's the same thing I'm seeing. Buyers that, were qualified to buy a certain level and they had their hearts set on that level, and the sellers have not yet adjusted enough. And so the buyers are essentially priced out of the market. And then on the buy side, I'm seeing two pieces of fear, right? Number one, hey, if the market's really going to crash like 2008, why would I buy today? And then the interest rates have gone up so much, I'm just going to wait for them to go down, right? Which is crazy. And then for me, I sell a lot of portfolios for investors, and all of my investors, as they see the market cool off, they've now cooled their jets on providing inventory to the market, because they're, going to see, hey, next summer, is it going to go up again? These assets are still producing income because rents are so high. So maybe I'll just hold off, for the next upturn. So that's what I'm seeing.
Totally. So you guys made a bunch of really great points. So I want to take them in segments because I think they're all really interesting topics to discuss. The first thing that I want to share, and let me see if you guys can you see my screen?
It's coming up. Yeah.
Cool. So the first thing that I think we should talk about right now is the fear of the market's going to crash. We're going into another recession. If I buy now, my house is going to be worth less than I purchased it for. So historically, I think it's just really important on all of these topics to go back to, history and really, share data and facts with regards to mortgage rates and recessions, and then, house values. I think we may see, a small cooling. I think that's more normal. Part of it is this time of the year. Part of it is what's going on with the interest rates. But historically, the last several recessions, the only recession where we saw a dramatic decrease or depreciation in home prices was in the 2008 recession, because it was based around housing. So that historically is not true. So because what we're entering into potentially right now is not based or created on a housing crisis, it's less likely to occur in terms of, a massive depreciation or loss of, 10, 15, 20% in equity. What are your thoughts there, Russ?
Yeah, no, I 100% agree, right? Like, we just go back to the two main factors on housing prices are supply and demand and inflation. And inflation's going up, which means the price of houses eventually will go up because that is a durable good. And as the money supply continues to increase, the price of houses go up. Story. And then again, we're still in a restricted supply situation. And when I say supply, I don't mean the number of houses that are available for sale on the market. I mean the total number of houses that are available in the US. And again, each market may be a little bit different. And when we're not getting a bunch more at affordable prices, because when COVID hit, everything became more expensive. If anybody's done flips or, as builders, you can't get laborers, you couldn't get, appliances, you can't get windows, you can't get any of these supplies that you need to build these houses. So they were much more expensive. They were taking a longer amount of time, and, people don't like to take losses on them. And so I think the prices, what they call, are very sticky downward, right? And they go upward very quickly. So I agree with you.
Well, and also, just like any asset, a stock, a bond, a home, you only realize a gain or a loss when you sell. So if we're selling primary residences to families, if they purchase a home and their goal is likely to be to keep that asset long-term. So it will fluctuate. But I don't personally believe that we're going to see a massive, depreciation in the asset that they just purchased. And the other, every other positive around home ownership definitely outweighs I believe the risk of even just a cooling. So there might be a flattening of appreciation, but I don't personally believe there's going to be a massive depreciation. And history tells us that is likely to be the case going forward. So I think that's super important to note. Jody's point that seller expectations with regards to the pace of the market is also good. And I love, Jody, the way you explained that in such a calm, professional way. I think that's our job as real estate professionals, is to educate our clients that listing a house and having 17 above ask offers within 24 hours is not normal. I would argue that that's actually worse for the market in general than, a more normal sale time of, what we've seen over the last several years. What is, in your professional opinions as agents, what is a more normal cycle time for a seller to accept? Like, let's talk about what a more normal market might look like, so that as a group, we can be sharing that and, preparing our sellers better so that we can have those conversations up front. What do you usually tell people that's normal?
This is Kelly Jo Lovato. I've been in business since 2003. Hello, everybody.
Hi, Kelly.
Hi. I think 45 days. I used to always tell, and I would get the stats, get the numbers of the general area of the listing and find out what it actually is. But we thought that was fast when we started pushing the mortgages. The escrows to close sooner. That was just like mind blowing. I remember going from 45-day escrows to 30-day escrows. Wow. And then we went to, 14 and 7-day. It was amazing. It's like, what's going on? So definitely going back into a normal market for the most part. But there is something bigger going on that I'm really curious about. Ryan Lindquist is a very famous appraiser. I'm sure a lot of you have heard of him. And he posted something yesterday and said that sales for November was the lowest in 20 years. So that, I think collectively we're all coming together, trying to figure out exactly what kind of, for lack of better words, monster this is, so that we can adjust as needed, because there is a lot more inventory than we had, just a month ago, 2 months ago, and sales are down. So this is just some information I'm sharing, but to answer your question in the first part, and then just to add some more food for thought that maybe collectively we can come together and try to navigate.
Totally. I think that's really smart. And yeah, I do know Ryan Lindquist, and that is true. And I think what happens when we see a massive shift in interest rates, it's expectation versus reality. So all of these pre-approved homeowners, a lot of these people, because they haven't been able to get in contract because it's been so competitive, and, just here's the list price, and all of a sudden it's, just a race to 50, 75, 100,000 over list. They've been in this funnel for a long time. And so it's shocking when you go from, a payment at 3.5% versus a payment at 6.5%. So I think it's the shock to the system that has just paralyzed a lot of buyers and sellers. And I think that's what we've been experiencing in October and November. And what we need is a little more consistency in terms of, hopefully interest rates will stop being as volatile as they've been. Because I think it's the massive, like you just adjusted to, this unnatural behavior, which is like, oh, I don't even have time to go see a house, and now I have to make an offer that's $100,000 over the list price, to a more normal, yes, your payment is X. Hopefully your, loan professional has walked you through this and done, updated planning calls with you as things change, just to have full disclosure and to make sure you still qualify, but to have that conversation and say, this is where we are today. But guess what? You might actually finally be able to win on a transaction because there's so much less competition. You can actually go see a house in person. You can actually take a day to think about it. You might be able to go see it a second time. You can fall in love with it emotionally before you're just having to make this major financial decision. That was way more unnatural, I think, than what we're experiencing today. And hopefully most economists believe, and Russ, I'd be curious as to your thoughts on this as well, that in the next 12 to 24 months, we will see rates come down lower than they are today, and there will be an opportunity to refinance. And I know that you guys have heard this, if rates stay the same, then, great. And you lock in today. If rates go up, and you lock in today, you did great. And if rates go down and you locked in today, you can just refinance. So there's positives to all that, but I know that it's the dramatic shift from one extreme to the other that has made most people just kind of take pause and not take action. And I think that's what we're seeing for October and November. And I'm encouraging, my agents to be having, that's a perfect conversation to be having with them, going through, no, this actually is more normal. This is more healthy for our market. And here's why. And I think just having that experience and being that voice of reason is so critical. Over communicating what you're seeing and what we're seeing, and the expectation for the future, I think is important. But in this market today, I'm seeing the ones that are here are serious about buying and they're serious about selling. And you guys as real estate professionals know that when you've got serious buyers and sellers, there's deals that are being done. And there's a lot of creative ways to do that. And I think we can maybe launch into talking about some of those things that we can do as professionals, because what I don't want to see, and I think we all have the responsibility to pay attention to, is we don't want to create a situation where we're, excuse me, racing to the bottom in terms of, you listed here, you don't have an offer in 10 minutes, so you're just going to race to the bottom. Excuse me.
Yeah, I would say, yeah, Karin, but to answer your question, I agree. Like they say, you're going to marry your house, right? But date your mortgage. Pretty much everybody at some point, if they've owned a home for a long time, they refinance, right? Whether they get into a 15-year and they can afford more because they've been there a few years, they have more equity, and so now something else makes sense. And if you just look at, I just look at the chart that you put up earlier in my mind, over the last, 50, 60, 70 years, interest rates have continued to go down and down and down. And if you study a country like Japan, I mean, they were at 0% interest rate for a while, right? So I think that we are going to see that. And I think for sure that you marry your home and you date your mortgage. And I think what's cool is I think most of the people on this are agents. And I know that we're going to talk about some secret weapons, right, to take away a little more of the fear, make stuff more affordable up front. And so that's pretty exciting that's going to be the next thing that we talk about. Everybody's going to have an extra tool in the toolbox.
Definitely. Well, let me share my screen again. Thanks for rescuing me from my coughing fit there, Russell. So some strategic mortgage products, and I'm sure that a lot of you have heard about some of these. So I'm probably not going to share anything that's necessarily, too mind numbing or riveting, but what I have discovered is when I talk to agents about some of these ideas, a lot of them don't really know how they work. And so what I want to do is spend a little time going into some of the detail and really answering some of your questions. So no question is a silly question, but let's really understand how these work so we can sell them. So the 2-1 buy down or the 3-2-1 buy down is a product that I'm sure you've gotten a lot of buzz into. And what I'd like to suggest as a listing agent, if you have listings that you're considering a price reduction on, before you consider a price reduction, let's consider a seller funded temporary buy down. And here's why. If we can, as a group of professionals, lock arms, maintain price points, that will actually maintain the integrity of values in a whole area. So before you jump to just lowering the price, if you don't get, 50 above ask offers in 12 minutes, talk to your sellers about the magic of the buy down. So there's a bunch of different types of buy downs. There's a 1-to-1 buy down, a 2-to-1 buy down, a 3-to-1 buy down. They're temporary, and let me explain the mechanics and the math of how these work. They're all funded by the seller. So this does have to be contributed by the seller, but it's a great way for a seller to make their home more affordable than the neighbor's home that's listed at the same price point, because the seller is actually paying a portion of the buyer's mortgage payment for the first 1, 2, or 3 years that they have that loan. So you do have to be cognizant of the seller contribution guidelines for whatever loan program the buyers are using. So that's why I've got this slide up. And every buy down is a little bit different. So if you see on this first section, this is conventional loans. So if you have a buyer putting down less than 10%, the maximum that the seller can contribute on a conventional loan with less than 10% down is 3% of the purchase price. So if you've got a seller that wants to get really aggressive and cover a 3-2-1 buy down, which would mean the buyer's interest rate is 3% lower the first year, 2% lower the second year, and 1% lower the third year, because that's going to be a relatively large cost, that buyer is going to likely need to put down at least 10% or more so that they can get into that 6% category, as 3% likely won't cover the entire buy down. And on a seller funded temporary buy down, the seller has to pay every dime of that. So I can't contribute as a lender. You can't contribute as a realtor. So it has to come completely from seller concessions. On FHA, VA, and USDA, they have a little more flexibility. VA can go up to 4%, up to 100% loan to value, and FHA and USDA are both 6% for their maximum. So if somebody's got 3.5% down and they want to do a 3-2-1 buy down, they might need to couple that with an FHA loan as opposed to a 3 or 5% down conventional. Does that kind of make sense with regards to the actual limitations on those programs?
Hey, real quick question, Kareen. We're in Denver. So is this different from California to Colorado, or is this pretty much national that the seller has to contribute to the buy down?
Excuse me, that is such a great question. It almost killed me, but it's a great question. On these types of loans, yes, they do have to be contributed by the seller, and these are national programs. So this is true whether you're in Denver. I'm actually in Portland, Oregon, California. So yes, I'll try to speak to these in really general terms that would apply nationally. That's a great question. Thank you.
Hey, second question is, with regard to these, is the qualification process for the buyer impacted by a 3-2-1 buy down?
That is also
a
question.
You got
That's also an awesome question. And Raj, I'm going to get down to brass tacks on how they're calculated as well. So that's coming up. Yes. So the qualification doesn't change whether you're doing just a regular conventional loan or you're doing a seller funded temporary buy down. So they're coupled. The buy down feature, it's more like a feature than a loan program, if you will. The buy down feature can be added, kind of like a rider, a component to a conventional loan, or a component to an FHA or VA loan. So if somebody qualifies for a conventional 10% loan, then they would be eligible to utilize a 3-2-1 buy down, request the seller to cover it, and move forward in that sense.
Karin, I guess my question was more around the price. So like, if, based upon my ratios, would I qualify for more if I do the buy down because I'm going to have?
Oh, I see.
Yeah.
That's a great. Yeah, no. So that's an important question too. Great job. So they still have to qualify at the note rate, and the note rate is whatever the mortgage is locked in at, and that's your fully amortized long-term fixed rate. So that's on your note. If you lock in at 7%, you have to qualify for that loan at 7%. So you might get to pay a payment that's based on 4% for the time being, but you still have to qualify for that 7% because eventually it'll hit that fully amortized portion. So eventually the credit that the seller is providing will run out. and you will have that loan going forward. The nice thing about these is that if we are predicting correctly and interest rates do come down over the next 12 to 24 months, you will have an opportunity to refinance before you get to that fully indexed point. And any money that's left over from the seller funded buy down actually goes towards a principal reduction. So if you haven't used all of the money that the seller contributed to you, that doesn't just go away. You can use that towards your cost of refinancing or a principal reduction. So that's your money, you get to keep it. And that's positive for the program as well. So how the heck do they work, Raj? So this is an example of a conventional 30-year loan with a loan amount at $500,000 and an interest rate of 7%. So in this example, we're going to be discussing a 2-1 temporary buy down. So a 2-1 temporary buy down would essentially be the customer, so the buyer, for the first year of their payment would be making a payment based on the note rate, which is 7% minus 2%. So the first year, your buyer will be paying a principal and interest payment that's based on a 5% interest rate. Well, what happens to that difference between 5 and 7%? Well, that difference, the $642 difference between the payment at 7%, $33.26, and the payment at 5%, $26.84, that $642 is paid for by the seller. So to calculate the math on how much the seller would have to pay, you just take that payment difference of $642, multiply it by 12, so 12 months, and the first year, that would cost the seller $7,704. So really all that's happening is the seller is setting aside money to make part of the buyer's payment for them for that specified length of time. Does that make sense?
100%. And so like on this one, for example, if this person was only putting 3% down and they were at 515, they would still be okay because the 3% that is covered is well over the 11,600 and some change that's here. So you would be totally good on this one on conventional.
That's exactly right. So in this example, the purchase price say would be $516,000. And if we say what 3% is, that's about 15 grand. Let's see, 516. That's 15,480. So in this example, this passes the test because the seller contributions of $11,652 that are required to fund this are less than the program's maximum of 3%. So that's exactly why you would use a 2-1 buy down with 3 to 5% down versus a 3-2-1. So in year 2, the same calculation is done, but this time it's 7%. My slide's wrong, minus 1%. So it would be 6% interest rate. The monthly payment in year 2 for the buyer would be $2,997. The cost between the 7% payment and the 6% payment is $329. So year 2, it would cost the seller $39.48 to cover the buy down. So in essence, the full cost of the buy down. So all this is a seller is putting money away, kind of like you put money away for taxes and insurance in an escrow account. The seller is putting money away to help pay part of the buyer's mortgage payment. Now, how you could market this as a listing agent is instead of, your house has been sitting stagnant for, 2 whole weeks, instead of lowering the price by $25,000 to try and, cue some activity, you could discuss doing a $12,000 contribution, which still nets the seller more than a $25,000 price reduction. And you can advertise the house that you're selling has a $642 a month lower mortgage payment than the neighbor's house that's listed for $515 for the first year, $329 less for the second year. So it's a really great way to make your house stand out from the competition while keeping price points at such that you're not devaluing the entire market. So your commissions are still based on the purchase price. the seller's happy because you've come up with a creative marketing strategy that's, bringing some excitement that might be a little bit different and a little bit new. And I think it's a great tool to use. Appraisals are still coming in exactly where they need to. So I haven't seen personally, values declining from an appraisal perspective. So the buy downs, the temporary buy downs are just really smart tools for you guys to be using right now to maintain the integrity of the market. And your clients that are buyers can go, man, I remember when rates were 5%. This payment is so much less shocking. And even if it's only for the first year or 2 or 3, I know that I'm either going to be able to refinance in, the upcoming future. I'm going to get paid more. My job's going to continue to increase, or I'll just be able to start getting more used to a higher payment. They qualify for it. They still qualify to pay 7%, but it helps them ease into that payment maybe, and, hopefully take away some of the sting from, having rates increase. But there's so much less competition now that if they still qualify, they're going to be able to actually get a home finally. Any questions on the buy down?
And then you guys all agree, what do you guys think is the best way to market this? I mean, would it be at an open house? Like, hey, listen, the seller's willing, if they're willing to have some flexibility, they're willing to buy down, the rate 3%, right? They're currently at 6.7 or 6.8 or wherever they are in your area. They're offering a 3.8 rate for the first year, based upon your down payment, of course, but, would that entice your buyers? Or what do you all think is the best way to do that? Obviously, going through that slide explanation is like too much, right? For a buyer or a seller. But I think as a buyer, if I knew this person was offering me a buy down of 3% on the rate, I would be much more likely to buy.
I think social media, and I think what we're doing right now is vital for us to tap in and to hear this repetitiously, so that for myself, I want to be second nature to understand it, fluently, so that I can then turn and educate my following. And then, marketing materials, social media, and getting on lives and explaining it, to the best that we can, legally and so forth, and with our lender partners as well. Because I was like, oh, that's what it is. It's like an escrow account, you know what I mean? But it's so needed. I mean, back in the before 2000, interest rates were 14%. Home costs were way down, but it's just a change that we need to adjust to and grab it by the horns with knowledge.
That's totally perfect. And I appreciate that so much. And that's why I think it's important to go. I wanted to do that exercise. I know it took a bit of time, but to go through that with you guys, because I hear people talking about do buy downs, do this, but nobody goes through and explains the mechanics to you simply. And I'm willing to do that for any of your buyers as well. Or sellers. I think it's important that we understand the tools that we're discussing, and there is a way to simplify them so that it's digestible. And we're trying to solve for the volatility and the change. So we're addressing a fear. So the fear is, oh my God, my payment is $642 more than I thought it was going to be. I can no longer afford to become a homeowner. And that might not be true. Everybody would rather pay $652, less than more. But if you go through and explain these things, suggest some alternatives, and then really define them clearly and simply, I think that's powerful. And I think as professionals, that's what's separating those of us that are going to have success this year and, continue to be realtors and be lenders and be in this business, from those that aren't, is that we're really going to have to educate, guide, train, coach. It's no longer just sticking a sign in the yard and cashing your paycheck. It's very, very different. And not everybody is willing to work like that. So those of you on this call obviously are. And that's the differentiator, is that you're a guide, you're an educator. You are that calm, cool, collected voice that can say, hey, I know you're worried about payments. Here are some ideas of, things that I would suggest that might help ease that burden or ease that fear. And that's how we take the fear out of this market, is with education and simply providing value in that sense. So great feedback. Thank you so much for that.
Thank you.
Yeah, you guys. And I seriously, if any, even sellers, I mean, obviously, if you need some help, I'm happy to jump on a quick call and just in general terms, explain how they work. And I think people don't know that that money is theirs. I think they think, gosh, if I do a buy down and then I refinance in a year, then that money just goes bye-bye. And no, that goes to reduce your principal. That goes to, I mean, you guys saw you've got thousands of dollars still left in that account after year one. Use that to cover your refinancing costs. So it's a really smart tool. The 3-2-1 is even more powerful. And the thing I love about it for sellers, especially, is if you can say, if Raj, you can say, seller, your house is $642 cheaper with somebody that's going to make an offer with us versus buying the neighbor's home at the same price point. So it's really smart. And being able to explain it simply and clearly, I think is really, really key. So I would
include it in the public remarks, you know, when you advertise, as the board allows for it, just say seller is willing to do a 3-2-1. Russ, what do you think?
Absolutely. That's it. And that is such a great point. And I'd love your guys' feedback on how to say that or explain that in a simple and compliant way. I've actually got a big builder up here in the Portland market, and, you know, let me know if this is a concern for you guys too, but they have, you know, 215 units and multiple plats that they are working on, selling, and they're selling in phases. So, you know, they've sold some of them, they're continuing to sell others, and they have a big problem right now where they're going, gosh, everybody that's starting to move into these houses that they've purchased for, you know, 450, 460, 480, buyers don't want to buy at that price right now. So we actually created a whole marketing plan around utilizing a temporary buy down that the builder is paying for to get people off of the fence that are fatigued, get them back into the market to buy these homes, but then we're not devaluing the purchase price of their whole neighborhood or ticking off the clients that, you know, closed 3 months ago at those price points. So it can be extremely powerful when you're also speaking with builders and going in there to address this systemic issue that they're undoubtedly feeling, going, gosh, what are we going to do? We can't sell anything right now. And we certainly don't want to lower our prices because that's going to set the stage for the entire rest of the community, which is not good for the people that just closed and certainly not good for, you know, setting and staging values going forward. So it's a really smart product.
Can you share some of the marketing plan?
Yeah.
Also, if I could add to that last point, yes, I've heard of a couple of small builders that are actually going bankrupt because they had this overwhelming list of buyers that were, you know, getting ready to place a hold on a lot. And because rates went up, they no longer qualified or they didn't want to, you know, and yeah, I know of a couple of little subdivisions in Folsom. And so that's huge. So I'm just really trying to put all this together to find a power position to try to help people. But I think the puzzle pieces are coming together slowly, but surely we're going to figure this out.
Totally. And I'm telling you guys, if you did nothing but take this marketing information to these builders and say, I have a way to save your community, save your business, let's not file bankruptcy, here's a solution. Holy cow, if you came to somebody with that idea and that opportunity, why wouldn't they do it? And then guess what? You've got yourself a new builder and a ton more opportunity. So that little nugget of information could be what you focus on in your business going forward. I think that's huge. So if you need support or marketing material, I'll fly down there. I need to get out of Portland. It's cold and gross up here. Get me out of here.
Hey, Russell, I had a question. Is it okay if I share my screen?
Yeah, I think I've made it where anybody can share.
Okay, I'm going to share it. Let me know when you can see my screen. Can you see it?
Yep.
So how does it work filling out the paperwork? Do we basically put it here in like the first loan and then go seller financing, or do you mind explaining it on a car form, how to fill it out?
Yeah, it's just like it would be if you were asking for, as far as for my purposes. So I can't speak to other lenders, but if we're working on this together, I like to see it as just a straight seller contribution on the purchase and sales agreement. What you have to make sure is that we've got that dollar amount nailed down, because the seller has to cover 100% or nothing. We need to make sure that we get the math down perfectly. And I've got a really simple Excel spreadsheet that I go through when I pre-approve these. So you would just mark it like you would on any normal seller contribution. And you can just say, you know, $12,000 towards closing costs, prepaid items or reserves, and just keep it general. And then I use it towards the seller funded temporary buy down. That's a great question.
Yeah. And Raj, technically I would put it in section E.
Section E? Oh,
Yeah.
under here, under additional financing?
Yeah. I would just put, seller agrees to credit buyer, $11,367 for a 2-1 buy down.
Okay.
Is that
So you don't,
is that the most
you don't have-
updated contract?
I believe it is. Yeah, I think so.
I don't
Oh,
think
actually,
so.
you know what?
It's not, but
No.
that's okay.
Wait, hold
No.
on. This is
So if you had the more current one, we could tell you more precisely.
yeah. Let me pull up.
But
the
it's
current
going to
one,
be a
sorry.
section like that.
Exactly. Not to waste or not to utilize
Yeah,
the
you're
time
right. You're right.
unwisely.
That was the old one. That was the old
It's
one.
below the boxes on the new one. So there's the boxes and then there's a open section. And that's where I would put it. Here's the key is it just has to be in there. Both people have to sign it and they have to agree to it, right? And the number needs to be right. So I would say, like Karin says, what I always say when we're doing a seller credit of any kind, by the way, this is super important if you're working with a buyer. And sometimes, I mean, I have a high level of integrity, but if, somebody is working with a buyer and they don't know what they're doing and they ask us for a credit, right? Well, there's certain amounts that are limited on credits for lenders. So even though they asked for 15,000, they may be limited at 11, and at 11, then the seller has no more obligation if it's not worded correctly. So if you're working with a buyer, make sure that you get it right.
So basically, check box E. This one, the seller financing.
No,
And then
absolutely
another-
not. No, it is not seller financing. Uncheck that box.
Which one would it be?
It
You
would
said-
be
it's
keep
a
scrolling
credit.
down.
Yeah.
Keep scrolling down, and you'll see a additional
Right. You could do it right there in G2.
additional financing terms, G2.
Yeah.
Or you
G2.
could do the credit. That would be fine too.
Yeah.
Right.
There you go.
Right.
But I like the additional financing terms just because it has extra room.
Okay.
And because it's not a percentage of price, but you could do a dollar amount. But I like E. I like G2. G2 on the new
G2.
one. Yeah, E on the
Okay.
old one. And then
Okay.
again, get with the lender, right, to make sure that you get the number right.
Okay. Cool. Thank you.
Yeah. Because there are limits.
And I can help anybody with that too, Raj, and that's kind of specific to, the buyer to their programs. So that was that screen that we looked at that talked about the maximum percentages based on down payment. And if you want to get really aggressive, so the builder that I'm working with, they're actually doing a 3-2-1 buy down. So those are substantially more. But their big thing is they want to be able to advertise that they have payments that are based on rates in the 3s, and a 3-2-1 buy down. I mean, if you're locked in at 6.5 today and you can pay 3.5% for the first year, 4.5% for the second year, I know we're going to be refinancing people in that window. So not only do you have a major payment floor that you can start with that can kind of ease you into that higher payment, you'll have a nice little piggy bank of reserves left when it's time to, refinance your mortgage. And refinancing, people, it's like you don't want to expect to refinance, but the facts and the statistics are true. Literally 90% of 30-year mortgages are refinanced within the first 7 years of any loan. And that's refinanced or paid off, I should say. So that is whether somebody sells, whether they refi, whether they pay it off. Whatever they do, people don't keep mortgages for 30 years. They just don't.
So when it comes to the marketing, because I think this is great, right? But if we don't implement it, it does nobody no good. And we can get bogged down with the marketing so much. Are you licensed in different states? And how much are you able to help with that?
Thank
I
you, guys.
am.
I'm gonna take off. I really, really appreciate all of this. This is so vital and key for our success. Take care, everybody.
Thank you. Such great
Bye-bye.
feedback. I really appreciate it. Nice. Yeah,
We'll be in
on that
touch.
note, and I just want to go through. Absolutely. I'll get your information from Russell.
Okay, thank you.
Um,
Bye-bye.
Yeah. I'm licensed in Washington, Oregon, California, Idaho, Arizona, Florida, and Texas. But I've got people within my group that are licensed all over the country. So there are great, and I am so like our loan officers are awesome. I obviously I'm biased, but I'll introduce you to somebody wonderful that's located in your state if I'm not licensed there. We've got a whole marketing team. We've got flyers that we can create for you. We just need your logo and your headshot and your details, and we just pop them in. It's Canva. They're high quality. They're compliant. We can make changes to them. So yeah, we try to take a really active role in supporting our partners because guys, I'm not in business without you. So it's vital that we support each other and help each other. And that's really why I'm doing this, and we're doing coaching. I don't know if any of you know who Rene Rodriguez is, but he's a world-renowned famous speaker that uses neuroscience to predict behavior. We do goal setting. So we actually have we've hired him to do a 3-hour essentially presentation for our teams and then our agents that we have invited. Joe's going to join me. Russ is going to join me. If you have interest, please reach out and we can chat about whether or not you'd like to attend. That's on December 7th. So we know that we don't survive without each other. So that partnership is vital. And I want to do everything I can to educate and empower you guys so you're comfortable talking about this stuff. I know we don't have a ton of time. I want to be really respectful of everybody's time today. So I want to go quickly. I know you've all seen this on, we talked about kind of how this market might actually be better for buyers and sellers. One quick point I want to mention is when everything was so crazy, I saw a disproportionate amount of FHA and VA buyers just be completely knocked out of this market, last year, so 6 months ago and previous, due to cash buyers and, larger down payment conventional buyers. And if you have people like that, I really encourage you guys to get them off the bench and back onto the field. Like they can actually have some success in this market. And I'm happy to have that conversation with you if that would be helpful. But we're finally seeing, veterans and first-time home buyers get some traction in this market. And I think that's just a major opportunity for anybody that was fatigued and needs to get back out there in the market. I know you've seen this graphic on online, and I thought it might be helpful in the rest. Do we have time to go through this real quick, or should I wrap it up?
I say go through it.
Hello.
Yeah, I think we do, but let me double check. I think we do. I'm 99% sure. We
Okay.
are good. Yes, go ahead.
Awesome. Okay, so I know you guys have all seen a graphic similar to this on online, and I wanted to explain it a little bit in detail. It's definitely interesting. So a 2021 scenario compared to a 2022 scenario, and sort of how the reality of the math might work. And it's probably a little bit exaggerated, but I think it's a good illustration all the same. So in 2021, we saw list price was 500,000. Well, the house didn't sell at 500,000, right? It sold at 550. So if you had $100,000 down payment in that scenario and you bought at 550, your loan amount would be 450,000. That's not quite 20% in that scenario. So you'd have about $50 in that monthly payment devoted to mortgage insurance. But your mortgage insurance, your principal and interest based on 4% in that scenario, your payment would be $2,186. Today, your list price might be 500,000. Well, you're not settling at 550. You might be settling at, 475, 450. So that might be a little bit of an exaggeration, but it's probably not going for list price. Your down payment is still $100,000. That means your actual loan amount, so what you're financing is $350,000. Your interest rate's quite a bit higher at 6.5%, but you're putting down more than 20%, and your payment is relatively similar. So I think the importance behind this graphic and the power there is just reality around these are the facts versus the hyperbole that we see in the news.
Well, and you can get rid of the interest rate. You can't get rid of the extra 50 grand you paid, right? Like,
correct. That's a true point. So the fact that you could actually get a home probably for closer to what it's worth and maybe an inflated value, and you don't have to pay for it for 30 years. Hopefully we'll be able to, fix that interest rate in the future. Does anybody have any questions while we're
Yeah,
here?
I've got a question real quick. So walking into a seller presentation and, just coaching the seller as far as what they may actually have to pay for this 3-2-1 buy down. I mean, everything is just so contingent on how much the buyer's putting down, what type of loan it is, the purchase price of the home. I mean, how do we walk in, with a seller and say, if we want to do this 3-2-1 buy down, we're probably looking around 10 grand. We're probably looking around 15 grand. What's a generic or an average mathematical equation that we can walk into and say, this is probably about what we need to look at as a purchase or as a cost?
That's such a great question. So you want to be careful that you're not, being the mortgage guy. So I'd probably suggest it in general terms, and then, have them talk to somebody like me to explain it. But let me just share my screen again. So this is our buy down calculator. So literally this will tell me exactly what that would cost. So let's not do 6 million. They probably don't need to buy down. So let's do 600,000. Let's say their interest rate is their note rate 6.75. So this is how I go through and calculate this. So on a 3-2-1 buy down, the mortgage payment is $38.91 in this scenario. For the first year, it's going to be almost $1,100 cheaper. And this is what the seller would have to pay to cover the first year. This is the second year. This is the third year. So in a 3-2-1 buy down scenario on a $600,000 loan, it would cost the seller $26,526.24 to cover that whole amount. And the client would make a payment of $27.95 principal and interest the first year. So and then this would be a 2-1 buy down. So if they're, and then this would be a 1-to-1 buy down. So it's just, and that's $4,000. So to temporarily get a buyer to a whole 1 percentage point lower for the first 12 months. I mean, these numbers are not necessarily huge. So this is good information to have. And I think I can probably share this Excel spreadsheet with you. Would that be helpful?
Yes, please. Yes.
Are we doing this together, Scott?
Yes, ma'am.
Love it. That's so great. And I always tell people it's not, that it is based on the buyer. So if you're going and telling the seller, hey, it's going to be 26 grand, you don't know if they qualify for a 6.5% interest rate. Maybe they've got, a 420 credit score. I don't know. But it's based on what the borrower would qualify for. So it's a buyer and seller component. So that's where, the education around it and, hey, this is an idea, this is an option, this is about how much it would cost. And then when we get the buyer, then I take them, I pre-approve them. Then I say, okay, you're actually an FHA buyer. This would be your interest rate. And then this is how much it would cost roughly for the buy down. And that's kind of where the negotiation between buyer's agent and seller's agent can kind of start. But that'll give you a good, at least, it's a more informative piece.
Nice. And you're licensed in Colorado for lending?
I am not personally, but I have great colleagues in Colorado that I'll be happy to share a good referral with you. That's absolutely no problem.
Okay. All right,
Definitely.
awesome. Thank you.
Hey, thanks again, and I appreciate
The only other thing,
Go ahead. What do you got? One more?
oh, okay, the only thing I'm gonna go through again is just kind of growing your reach with social media, but maybe we'll have to do this again, because I think there's a lot of stuff that we can do together. And we touched on it, but from
Yeah,
that
I mean,
perspective as well. So
if you have a social media piece that you want to share with us that we can share, that would be neat.
I think just in terms of creativity in how we can combat this market and what we can do, I'm definitely finding for myself and my team that we are, working a lot harder, being a lot more consistent, and just very intentional about how we are handling our business. So it's no longer we just sit in our offices and phone rings anymore. We have got some, we've got to work. We got to remember how to hunt. And that encourages me and excites me. And I've always loved social media. The great thing about it is you've just got a bigger stage, and not everybody's super comfortable with it, but I would highly encourage you to start growing your reach and start growing your network utilizing social media, whether it's TikTok or Facebook or Instagram or LinkedIn. I know you guys do a lot of recruiting too, and I'm amazed at how much success people have recruiting on LinkedIn. It's extremely powerful. I've got a social media person that I work with, but I've also committed to, posting on TikTok regularly. And I know it sounds a little corny, but I'm enjoying it. And I'm getting a lot of engagement from a lot of different places, because there are there's a ton of millennials out there that are interested in home ownership, but they may not have been given the best information from, all the sources. And a lot of them had parents that went through the, 08 meltdown and lost a home. So there's some fear there. So I think identifying those people and starting to have the conversation. I always tell people about my why. I bought my first home when I was 21 years old. I was literally 6 months out of college. My parents thought I was a complete crazy person. I bought that townhouse 3 years later, sold it, and made $80,000. Totally changed my life. I don't think there's very many 25-year-olds today that can save $80,000 just via working. So the power of real estate, the power of becoming a homeowner, as soon as you possibly can, finding those people, those buyers that need your guidance and need your education through social media can be incredibly powerful. So if you're not doing it, I encourage you to, and really just be yourself, be authentic, and be consistent. That's the biggest thing. And that's true for anything. You guys know that.
So do you have a library in Canva maybe that we can tap to share so we don't have to build from zero?
Yeah, I do. We've got, and I think I can share. Let me find out what I can and can't share. But what I can do is, show you some of the things that we can do, and then connect and see, go, gosh, let's create that marketing piece, or, whatever it is. They've made it very, very simple to tailor them and co-brand them, which is great. And they're great pieces. So, and I think that's important. Sometimes just having that content to then get out there and share it, and then talk about it and start generating some buzz and generating some conversations is just really, really important. Or, just answering a question that a buyer or seller had for you, or addressing an issue that you're seeing. I think people are hungry for knowledge and information right now, and certainly something that's more positive than the doom and gloom that we have been seeing. I think there's a lot of real positives to this market, and there are people out there that are doing a ton of business. There really are. We've just got to find those niches, and man, get out there and talk to your contractors and tell them about seller funded buy downs. Let's keep those businesses alive.
So will you get our emails from Russell, or do you mind sharing your contact information?
Yeah, put it in the chat. So mine is just Karen at umortgage.com. So KAHREN at umortgage.com. Let's see if I can. And then my phone number is here as well. And if I am not licensed in your state. I will connect you with somebody who is, and connect you with all the marketing resources that we have available and any information. And your guys' questions were awesome. And thanks for sticking with us till the end. I really appreciate that. We went over it. I hate that, but I really appreciate you guys. And thank you, Russell, for the opportunity.
No, great stuff. Thank you.
Yeah, I think it's super helpful for everybody to be ahead of the market, right? Like we have an extra tool in our tool belt that most people don't, aren't aware of.
Yeah.
Cool. All right, everybody. Hey, have a great rest of your day. Thank you so much.
Thank you, guys.
Bye, guys.
Thank you.